Assalamualaikum and hi everyone. Welcome to my channel. I am Yusna Lisa Hamid and today we are going to learn the Mfrs 108 accounting policies, changes in accounting estimates and errors. So let's start. Before we start, let's look at the learning objective. So at the end of this topic, you should be able to explain the recognition and measurement of accounting policies, changes in accounting estimates and errors. The second one is that you should be able to estimate and apply the professional judgment on the initial recognition and measurement of an items that are provided in MFRS, right? Also to be able to show the presentation and disclosure of accounting policies, changes in accounting estimates and errors. MFRS 108. The intention of MFRS 108 is to enhance the relevance and reliability of the financial statement of the entity. So it should reflect faithful representation as well as provide the relevant information. And also ensure the comparability of those financial statements of the entity over time with the financial statement or comparable with other entities that are within the same industry. So as an introduction, this is the objective of MFRS 108, which is to prescribe the criteria, the accounting treatment, the presentation and disclosure of changes in accounting policies. We'll go into detail on that. Changes in accounting estimates. What are the accounting estimates? We'll go into detail of that. And also, when there are correction of errors, how do we identify the errors, detect the errors, and how do we make a correction or rectify the errors? For information, MFRS 108 cannot be tested on its own, but MFRS 108 will always be integrated with other MFRS. So to apply MFRS 108 is to apply that within the context of the relevant MFRS. The scope of the standard. So this standard shall be applied in selecting and applying accounting policies, and also accounting for the changes in accounting policies, changes in accounting estimate, and also correction if there are any prior period errors or a current error in the current period. The tax effect of the correction of prior period errors and retrospective adjustment need to be made to apply the changes, and that will be disclosed in accordance with MFRS 112. As a note here, our examples that will be provided here will ignore tax effect. We will just ignore the tax effect, but that should be done in practice, where those tax effect on deferred tax must be incorporated as well. So let's start with accounting policies. What is accounting policies? According to the standards, this standard, MFRS 108, accounting policies are the specific principles that are laid down by the standard. For example, basis, convention, rules, practices, which are applied by an entity that have been decided to be used by the entity, to be adopted by the entity in the preparation and the presentation of the financial statement. Accounting policies basically relates primarily to the recognition of any standard, any rules, recognition principles. It relates to measurement, basis, initial and subsequent measurement, presentation and disclosure. recognition and measurement are the one that will give rise to the accounting treatment. So we are going to look at whether there is a need for us to change the accounting treatment, or there is a need for us to revise the accounting treatment. Of the line item presented, so when we talk about line item, these are whatever that would affect the recognition, measurement, presentation, and disclosure of asset, liabilities, income, expenses, and equity that are in the financial statement of an entity. Accounting policies primarily deals with recognition. You can see the example here, decision on to capitalize and recognize in the statement of financial position is an accounting policy, and also whether to expense off, do we need to expense off if that does not if that was not being capitalized. So that is an example of accounting policies that were in the recognition principle. So you can go through this and notice these are all what you have covered before. Some of those things that you have covered in the standards like Mfrs 140, Mfrs 116, Mfrs 15, and Mfrs 102, and many other standards. Depreciation and amortization are not allowed to be capitalized. They are always expense off. Same goes for the impairment loss and also any loss on changes in fair value, loss on disposal. Next is the measurement, which is also an accounting policy. Accounting policy deals with measurement, so initial measurement, and what are the basis in the subsequent measurement, what are the measurement model used, what are the amount, how much is the amount to be included or excluded as an asset, is it measured at cost. These are all about measurement. Measured at fair value, what are those that comprise the cost, what are those that are regarded as fair value. So these are discussed in other standards. Like fair value, it is discussed under the standards on agriculture. Next is the cost model, revaluation model, and fair value model that were very familiar to us when we deal with subsequent measurement of assets like PPE, where it uses cost or revaluation model. So the decision to take up cost model over the revaluation model is an accounting policy. For Mfrs 140, for a fair value model may be the option as compared to the cost model. So this we're just trying to give example, and that is how you measure using revalued amount. For example, if it's for PPE, using for intangible asset, what are the carrying amount, carrying value. It is if you use cost model or revaluation model. So that will deal with also fair value, where when we talk about fair value model, there is an accounting policy and there is no depreciation. So these are some examples. Last one is when we talk about presentation and disclosure. When we are allowed to present the item in the financial statement, where are we allowed to present? Is it the SOPL, statement of profit or loss, in the statement of changes in equity, in the statement of financial position, or what are those items shown in the SOPL? Cost of sales, for example, expenses. So we are not allowed to present depreciation under statement of changes in equity. We are not allowed to show renewal preference shares in the statement of changes in equity. Income that comprise of revenues and other income. Revenues, where are the source of revenues? Revenues from contract with customers, for example, that are revenues. Share capital and reserve, these are the things disclosed or presented in the statement of changes in equity. And the issue of surplus that are part of other comprehensive income in the statement of profit or loss, which is part of disclosure, right? And also the asset, the categories of asset as non-current asset and current asset. Why PPE and IP are presented as non-current asset. Liabilities, all those different liabilities, non-current liabilities, current liabilities. and also liabilities which are financial and financial liabilities. These are also part of the issue here. Okay, let's look at how is the selection and application of accounting policies by an entity. According to the standards, an entity should adopt the standard if there is a specific standard on, let's say, Mfrs 116 dealing with how do we recognize costs. So that must be adopted by the company. And the interpretation, or there are any interpretation committee statement, any application guidelines in the absence of the standard applicable to transaction, other events or condition. But however, note that current MFRS limit the choices in accounting treatment up to 3 or maybe up to 2, like the model that were given, fair value model versus cost model. Those are some limits given in the standards, MFRS 140. And some standards only provide one accounting treatment rather than alternative treatment. Let's say the item research costs under the MFRS 138, it is always being expense off. Only one treatment for the research expenditure. Next one is when there is no specific standard. If there is no standard or any interpretation, management is to use their professional judgment in developing and applying an accounting policy. So management shall refer to the guidance and most recent pronouncement issued by the authority like Malaysian Accounting Standards Board or the International Accounting Standards Board in line with the conceptual framework. The conceptual framework, which is the document that gives the guideline on how to issue the standard and also other financial reporting rules. Next is to elaborate further on the part that we have discussed earlier, which is number 2, what happens if there is no specific standard or interpretation. Management is to use the judgment, yes, and how is the judgment would be like? It should be using the judgment that will result in information that is relevant to the economic decision-making needs of the users, as well as it should also be reliable. When there is no specific standard, the judgment should provide relevant information to the decision-making needs of the users and also reliable information, which will have this characteristic of faithful information, should reflect the economic substance, not merely based on the legal form, should be neutral, not biased. They are prudent and also complete. Next, let's look at some examples of accounting policy. So according to MFRS 116, for example, the selection over the cost model over the revaluation model is an accounting policy for subsequent measurement. The inventories that are measured at the lower of cost and net realizable value, that is the accounting policies with regards to the measurement of inventories. According to MFRS 140, for example, the choice to take up cost model or the fair value model is also an example of accounting policy. Under MFRS 15, the recognition of revenue from the sale of goods when the performance obligation is satisfied is an example of accounting policy as well. So these are some disclosure of accounting policies under a Malaysian company, Astro Malaysia. You can download the financial statement from their website. The one of Sime Darby that shows the disclosure of accounting policies on investment properties and leases. Let's look at change in accounting policies. If that is accounting policies, can we change accounting policies? The general rule is that an accounting policies must be selected and applied consistently from one period to another for similar transaction, events, and condition. It must be done and applied consistently. Consistent accounting policies will ensure comparability of financial statements over time. However, In certain circumstances, entity is allowed to change their accounting policy and can change its accounting policies if and only if it is mandatory. Mandatory means that the change is mandatory, or when there is a voluntary or discretionary change. For example, under mandatory change, it is where there is an initial application of a standard or an interpretation, as that was the requirement by the Malaysian Accounting Standards Board to comply with the new MFRS by certain date. So that is a mandatory change. And voluntary change is the change that will result in the financial statement of entity. If that is being done, that will provide reliable and a more relevant information. So change is allowed if the change will provide reliable and more relevant information. About what? About the effects of the transaction, other events or condition on the entity's financial statement, which is a statement of financial position, statement that reflects financial performance, that is the statement of profit or loss, and also the statement of cash flow. Let us look at whether there is a change in accounting policy. So here, the change in accounting policy occurs if there has been a change in recognition, right? We have just talked about accounting policy. So when you classify, let's say, rental that was previously and other income, now you classify that as revenue in the SOPL. That is the proof that you change your accounting policies. Measurement basis, when you decided to switch from using cost model to use revaluation model, switching that cost model to revaluation model for MFRS 138 intangible asset is a change in accounting policy. Or change in presentation and disclosures, where depreciation, for example, can be presented now under selling, where it was previously included part of admin expenses. The way the depreciation is being presented under different headings of expenses is a change in accounting policies. However, there are certain events that are not considered as a change in accounting policies. This is where the application of the policies for transaction or events or condition differs in substance from those previously occurring, or when the application of the new accounting policy for the transaction, events and condition did not occur previously or were immaterial. So let's look at one example of not a change in accounting policy. In this case, you have a company Asnaf Berhad own a building which are held for supply of service. So it is an PPE, in the current reporting period when reliable measure of the fair value of entity's investment become available. Now the entity, which is Asnaf, decided to transfer the property from PPE, where it was accounted previously using cost less accumulated depreciation less accumulated impairment model, to investment property that are now being measured using fair value model. So the issue is about a transfer from PPE to IP. Is that a change in accounting policy? So it is not a change in accounting policy, as the transfer of PPE to IP measured using different model is just a change in the use of the property. It is not a change in the accounting policy. It's just the change in the circumstances, the way a property is now being used. So let's look at the recognition and measurement of changes in accounting policy. According to the standards, changes in accounting policies must be applied retrospectively. What does that mean? Retrospective application implies applying a new policy to transaction, other events and condition as if the policy had always been applied for. So for example, when the change is decided, they decided to change from cost model to revaluation model for PPE in year 5. The change should also be applied for year 4, year 3, year 2, year 1. So it goes backward or it goes retrospectively whenever the condition are allowed, right? Whenever the situation allowed. There is some exception to this. Next, retrospective application. What does that mean? According to the standard, you need to, when you have changes in accounting policies, the opening balance of the component of equity, like the retained profit, for example, must be adjusted for the earliest prior period presented. We'll show this in an illustration. And the other comparative amounts disclosed for each prior period presented as if the new accounting policy had always been applied for. So these two, A and B, is the meaning of the retrospective application. What does that mean? It means the cumulative effects of the change must be adjusted or restated using the opening balance of each affected component of equity. Equity is in the statement of changes in equity. There should be an adjustment to include the line item where that would reflect the changes in accounting policy. And that changes must be shown, for example, in the statement of changes in equity, usually to the retained profit. How that has impacted the retained profit in the prior period or in the current period as well. Adjusting where applicable the carrying amount of the affected assets and liabilities. So where applicable, amount of asset and liability must also be adjusted and restated to reflect the changes in accounting policy. Accounting policy in terms of the retrospective application, however, has its limits. So the limitation is that when it is not possible, where certain circumstances does not allow us to do the retrospective application, the changes in accounting policy can be applied prospectively. And retrospective application may not be possible sometimes, as it is impracticable to determine the period specific effect. When was the first year that the changes should have taken place? If it's not possible to determine, not practicable, so we can do the application prospectively. And also when it is impracticable to determine the cumulative effect of the change. Maybe there were no more records that are available that will give you the information on how would the change be impacted. So these are some of the disclosures of the changes in accounting policies that are required to be made by the company when there is a change in accounting policies. You can go through this. And let's look at first example, example 1. Yatim Berhad has previously measured inventory using the first in and first out method, and it now intends to measure inventory using the weighted average cost method. The question is, would these changes be classified as a change in accounting policy as determined by Mfrs 108? So there are some tips that I would like to share here before you decide if there is any change in accounting policy. Number 1, ask yourself, does this involve a change in recognition? Remember, accounting policy is about recognition, measurement, and presentation and disclosure. So does that also involve change in measurement, either on the subsequent measurement or during initial measurement? Will that also involve any change to the presentation and disclosure? If your answer to one of these 3 bullets is yes, it would rather be, that would be a change in accounting policy. So in our case here, there is a change in measurement basis that are evidenced by a change in the method of inventory valuation, where inventory valuation now is measured using weighted average method as compared to previously using FAR270. So this would be classified as a change in accounting policy under Mfrs 108. The next one is about Kayangan Berhad. Second example, you can go through this. You would see that there was a change in the subsequent measurement of administrative building from cost model to revaluation model. So this is under MFRS 116 because cost model and revaluation model is under MFRS 116. Would these be changes to classify as changes in accounting policy? So if you see here, the answer is yes. The reason is because there is a change in measurement basis of PPE, where admin a building that are evidenced by the change in subsequent measurement from cost model to revaluation model. These would be accounted as a change in accounting policy. So we'll continue in our next session and in our next video.